President Trump has made headlines once again with a bold statement that immediately caught the attention of millions of Americans. He announced that he wants to limit credit card interest rates to 10% for 1 year starting January 20th. At first glance, this sounds like incredible news for anyone struggling with high-interest credit card debt. But the real question is this: is this actually going to happen, or is it just another political headline? And if it did happen, what would it really mean for consumers, banks, and the economy as a whole? Today, we are going to break this down step by step, using real data, real laws, and real financial incentives so you can understand what is realistic and what is not. Let's start by going straight to the source. In a public statement, President Trump said that the American public is being ripped off by credit card companies charging interest rates of 20 to 30%. He then said that effective January 20th, he is calling for a 1-year cap on credit card interest rates at 10%. Now notice the exact wording. He did not say that he is implementing a cap. He did not say that he has signed anything into law. He said that he is calling for a cap. That distinction matters more than most people realize. Calling for something is not the same as making it happen. Anyone can call for anything. Politicians do this all the time. They call for tax cuts. They call for lower inflation. They call for higher wages. But unless Congress passes legislation, and unless that legislation survives legal challenges, nothing actually changes. This is the first and most important point people need to understand before getting emotionally invested in this idea. Now let's talk about why this idea resonates so strongly with the public. Credit card debt in the United States is at historic levels. As of early 2026, total credit card debt has surpassed $1.2 trillion. That is not a typo. $1.2 trillion. Roughly half of all credit card holders do not pay their full balance each month. That means tens of millions of Americans are paying interest month after month at extremely high rates. The average credit card APR today sits around 22%. Some cards charge even more, especially for people with lower credit scores, at a 22% interest rate. A balance of $5,000 can quickly spiral out of control. Interest compounds. Payments barely make a dent, and people feel like they are running on a treadmill that never stops. So when someone says we could cut that interest rate in half or more, it naturally sounds like relief. In fact, if interest rates were capped at 10%, economists estimate that Americans could save approximately $144 billion per year in interest payments. That is real money. That is money that could be used to pay down debt, cover living expenses, or increase savings. But here's where the story gets more complicated. That $144 billion does not disappear into thin air. That money currently goes to banks. When you pay credit card interest, you are not paying Visa or MasterCard. You are paying the issuing bank. J.P. Morgan Chase, Bank of America, Citibank, Capital One, Wells Fargo. These institutions generate massive revenue from interest payments. Credit cards are one of the most profitable products banks offer. And that brings us to the core problem with this proposal. President Trump has reportedly discussed the idea with certain lawmakers. Supporters argue that this would help working families and rein in what they describe as predatory practices by credit card companies. Critics argue that it would reduce access to credit and hurt small businesses. And this brings us to the arguments banks are already making. Banking lobby groups have responded by saying that while they support affordable credit, a 10% cap would reduce credit availability. They claim that millions of Americans, especially those with lower credit scores, would no longer qualify for credit cards. They argue that banks price risk into interest rates, and if they cannot charge higher rates to higher-risk borrowers, it will simply stop lending to them altogether. There is some truth to this argument. Risk-based pricing is a core principle of modern lending. However, banks often exaggerate these claims to protect profits. What they rarely mention is that even with defaults, credit cards remain enormously profitable. The interest rates charged far exceed default losses in most cases. This is why credit card divisions are cash cows for large banks. But even if a 10% cap were implemented, banks would not just accept lower profits. They would adjust. And these adjustments would affect consumers in other ways. One of the first casualties would likely be credit card rewards. Cashback programs, airline miles, and points are funded by banks, not by card networks. If banks earn less from interest, they will cut rewards. Annual fees could rise. Late fees could increase. Balance transfer fees could go up. Credit limits could be reduced. Accounts could be closed more aggressively. Another likely outcome is tighter lending standards. People with lower credit scores may find it harder to get approved. Young consumers and those rebuilding credit could be shut out entirely. This creates a paradox. A policy meant to help struggling borrowers could end up excluding them from credit altogether. So where does that leave us? The proposal to cap credit card interest rates at 10% is a powerful political message. It speaks to real frustration and real financial pain. It highlights a system where average consumers pay extremely high rates while banks report record profits. But turning this idea into reality requires overcoming enormous legal, political, and financial obstacles. Congress would have to pass new legislation. Banks would lobby aggressively against it. Lawsuits would almost certainly follow. Even if implemented, the policy would come with trade-offs that are rarely discussed in headlines. Some analysts believe this is primarily a political move designed to energize voters and frame banks as villains. Others believe it could be an opening move to negotiate more modest reforms, such as tighter fee regulations or targeted relief programs. At this stage, there is no signed law, no executive order, and no guarantee of action. The most important thing for consumers right now is not to base financial decisions on headlines. Do not assume interest rates will suddenly drop. Do not take on more debt expecting relief. The system has not changed. And until Congress passes binding legislation, nothing is different. If anything, this moment should serve as a reminder of how expensive revolving debt really is. Credit cards are convenient, but they are among the most costly ways to borrow money. Even a 10% interest rate is not cheap. The safest strategy remains minimizing. Balances paying off high-interest debt as quickly as possible, and using credit strategically, not emotionally. This issue also exposes a deeper problem in the American financial system. Many households rely on credit cards not for luxury spending, but for basic necessities. Rising costs, stagnant wages, and limited savings force people into high-interest debt. Interest caps address the symptom, but not the root cause. So will a 10% credit card interest cap happen? Right now, the honest answer is probably not in the near term. Could parts of this idea influence future reforms? Possibly, but until the incentives change for lawmakers. And banks' meaningful reform remains difficult. As always, stay informed, stay skeptical of headlines, and focus on what you can control. Your financial habits matter more than political promises. And if there are real developments on this issue, we will break them down clearly and objectively when they happen.